Welcome to the Corlin Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Corlin Economics Report.
Hey everyone, welcome to the KE Report Weekend Show on this Easter long weekend. Just as a note, this show is being recorded on Wednesday, April 16th. We are going to be focusing on, again, the volatility in markets. However, this week has slowed down a little bit, but boy, oh boy, there's still a lot for us to talk about, especially when it comes to the commodities sector and precious metals in particular, where gold just continues to rip higher. First half of the show is going to be more of a recap of what's going on in these markets. Second half of the show, diving a little bit more into investing in metal stocks. One thing I should note is please go back, check out our website, podcast, YouTube channel, and Substack page for all our daily editorials and company updates, which there were a lot of again this week, just to stay up to date on who we're interviewing and more of a daily commentary on markets. All you have to do is search the KE Report on YouTube, on your podcast player, or on Substack. Without further ado, let's get into this weekend show, kicking off with Mike Larson. Mike is the editor-in-chief at MoneyShow. Mike, as we do with you, we can take a look at a wide range of markets, and really, if we take a step back, we are continuing to see a flight to safety being simply into gold. The US dollar broke down. Bonds, those aren't really going anywhere. It is money flowing into gold and volatility in gold, but mostly to the upside. Even the gold stocks are doing a lot better, a lot on higher volume too. So, Mike, what's your takeaway from, again, a market that still seems pretty tepid, pretty worried about what's going on, and gold being really the only standout right now in terms of a flight to safety trade?
Yeah, I'll tell you, I mean, the volatility across this market is just stunning, really, and across all markets, I should say. You know, it's funny, early on, I guess it was either very late, actually it was very early in February, I wrote a piece that kind of looked at the behavior of the VIX and some other volatility indexes in January. I said, look, if there's one thing that's certain in this market in a Trump 2.0 administration, it's that we're going to have higher volatility, you know. And this was before everything kind of went bonkers with the trade war stuff and the tariffs about 2 weeks later. It was just based on kind of what the market was starting to tentatively price in more volatility. Obviously, since then, it's exploded. I mean, you know, we're really kind of in a, if I had to sort of sum up what I'm seeing, it's a sell the U.S. trade, right? You're seeing, you know, stocks getting hammered. You're seeing U.S. Treasuries not acting as an insurance, selling off in tandem with equities a lot of the time. Not so much today as we record, but we've seen that trend for a couple of weeks now. The dollar just can't get out of its own way. I mean, that's been, you know, one-way trip down the elevator shaft the last couple of weeks. And with gold, it's funny, I used to always say, I won't know when gold's kind of gone into euphoric phase from just sort of a standard bull market phase until it started going up $100 a day. And sure enough, what have we been seeing for, you know, a few times in the last couple of weeks? Going up $100 a day in US dollars and so on. So, you know, at closing in on, you know, at more than 3,300 plus for gold, you know, silver starting to play along to, you know, 32, 33 bucks or so. It's a bull market that has a lot going for it, that it has had a lot going for it, but it's essentially been turbocharged by, you know, just not knowing what to do. I'll try and keep this, you know, apolitical, or keep the political side out of it, but I don't think, you know, what we've seen out of the administration suggests that we've got sort of a cogent, you know, well thought out, step-by-step plan. It seems to be like, just let's see what, you know, is going to happen, what's going to get thrown against the wall overnight and each morning and during the middle of the day, and see what sticks. And so in that environment, what's happening, you know, regardless of what the long-term goal is, and I understand the long-term goals, and I think it's actually admirable to try and, you know, bring more manufacturing and everything else back to the U.S. and so on. But the way it's being handled in the short term and intermediate term clearly has markets spooked, has foreign investors and governments spooked. You already had, you know, money flowing into gold and kind of out of U.S. assets from countries that didn't want to, or that were looking to sort of de-dollarize, that didn't want to, you know, go through the same things that like Russia went through after it invaded Ukraine, and, you know, some what happened with frozen assets there. So you already saw central banks migrating more into gold. When you layer on top of what was already going on, you layer on top a trade war, a very, you know, bouncing all around, eccentric, we don't know what's going to happen next policy-making approach. what happens? People look for safety. They question, and they question the safe haven status and the stability and the, whatever you want to call it, sort of the privileged position that the US dollar and US treasuries and US stocks have had on the global stage, and they move their money elsewhere. And that's what we're seeing. I mean, that's kind of the big uniting thing that I see happening out there. And it's a powerful trend. A little while ago, after we had that crazy Wednesday where, President Trump put the 90-day pause in place and you saw, markets explode, the third biggest rise in the S&P for one day ever, with the exception of 2 days, only 2 days that beat it. We're in the midst of the great financial crisis, if that tells you anything. But, is that the bottom? Is it a bottom? I think that the real issue is that until you get confirmation from gold, until you get confirmation from treasuries, and until you get confirmation from the dollar, this process of just selling the U.S., selling U.S. markets, moving money elsewhere. It's powerful. It's, getting turbocharged, and I'm hard pressed to figure out, what stops that. You can have moments where the move goes too far, too fast in the short term. Again, we may be getting close to that in terms of what gold's doing here, but, and in terms of the dollar and its downside momentum. But the bigger picture trend, the gradual slow money trend towards selling the U.S., that's what I think is potentially a bigger trend that we'll be talking about 6, 12, 18 months down the road, not just here, in 6 days.
Yeah, Mike, I think that's maybe where we should dig into even just a little bit further, is the idea that the slow money trend may be selling U.S. assets, because we have seen foreign stock markets get rallies and inflows into Europe and inflows into Asia. And it's surprising that some of the investors that maybe would have traditionally been in U.S. assets are pulling in their horns. And then the other thing is, from a company standpoint, if they're international or even if they're local, the tariffs, the on again, off again nature, is making it impossible to forecast what they should inventory, what components they need to bring in now ahead of tariffs, how they can expand in other countries, what that means to their bottom line. And sometimes small businesses are left in the dust because they can't just call up the Trump administration and ask for a favor or ask for an exemption. So just from that standpoint, what do you think the nature of the slow moving concept here is going to be as far as investing in U.S. equities?
Yeah, I mean, look, we had a market a couple years ago that was wildly dominated by U.S. equities overall, and specifically, these U.S. multi-trillion-dollar tech firms that are, the Mag 7, as we obviously called them. That was the trend. That was, this is American exceptionalism. This is nobody does tech like America. I don't want to put my money in these sort of sclerotic European banks and these other foreign markets. They're not growing as much as the U.S. Give me all U.S., give me all tech, and nothing's ever going to change. But what we've seen. First, we kind of eroded that Mag 7 market. We started seeing money rotate into other sectors out of tech, into financials, into industrials, into some other parts of the market. Last year, even small caps started to move a little bit. And what you have now is more of this global game that, tech sector supply chains are threatened by what's happening with the tariff. Clearly, these companies have spent years and years and years, decades really, moving production, moving a lot of things overseas. And now, in sort of the blink of an eye, they've got to cope with massive potential changes in the profitability of that approach. If you're Apple, you can, like you said, you can call up the administration, you get your lobbyists and, get these temporary reprieves like we saw. And that's why big tech rallied at the beginning of this week on some of that Friday night exemption stuff that was out there. But all told, it's a problem for small business, it's a problem for medium business, it's a problem for a lot of large companies. And, it sounds cliche to say Wall Street hates uncertainty, but in this case, it's the entire world hates uncertainty. And that's the other thing, too. It's like, okay, we got that 1 day rally on a 90-day pause, but does a 90-day pause really help? And it's not even a 90-day pause on everything. It certainly didn't pause the tariffs on China. It didn't pause the sectoral tariffs. The numbers. I mean, when you're tariffing uninhabited islands in the South Pacific or wherever it was, the South Atlantic, that island with a bunch of penguins on it. I mean, that doesn't instill a lot of confidence in what's going on. So that's what I think the real issue is. I mean, as a nation, America has enjoyed kind of what the British Empire used to enjoy decades ago, that being the world's benchmark, and that allowed the pound to be overvalued and all these things. If we now, sort of for whether you agree personally, in the longer term goal, but if we squander in this fashion in the short and intermediate term, there's going to be a lot of consequences, and that's what we're starting to see. It's capital flight from the U.S. to other markets, and again, the moves are spectacular in the short term with the fast money people, the people that are jumping on this that are more trading and short term oriented. But it's really the gradual long term rotation of capital that could have multi-year implications. You're a US based investor, you've been underweight foreign markets. If you start to make those reallocations when you readjust your 401k every 6 or 12 months, or the big institutions that move gradually, not in the blink of an eye, like the fast money traders, that's what could have lasting implications. And I think, in the metal sector in particular, you talk about metals equities earlier, you were mentioning miners and so on. They're so small relative to the market. It's such a sector that hasn't attracted money, big money, sort of institutional money for a long time. Now, institutions can't ignore a move to 3,300 gold, to 33 or 40 or wherever 50, wherever silver ends up going, if it does start to kick in. Copper obviously recently hit all or multi-year highs before it got smacked by the tariff stuff. So, you can't ignore those kinds of moves if you're an institution. And that's what I think, sort of fuels the next phase of this, is more of the not Warren Buffett himself, but those types of big money investors that are going to be putting more money into a sector that really hasn't attracted those kinds of inflows for a long time.
Yeah, that's a good point. The potential long-term implications of this, if we do truly see a shift in where capital flows globally. And that's the thing, right? So much has been focused in the U.S. trade, and the U.S. markets have been so much more focused on growth. So then where else would money go? We've heard Europe. Europe could be looked at favorably because that's been such a lagger. Europe is their stock market much more value focused stocks. China, there could be money flowing into Asian markets. But on the Chinese front too, look, everyone's talking about the rule of law in the US and how that is disintegrating, but it's not like China. Their markets are truly open for international trading, and they let all kinds of companies on there. So again, there's this big question mark of where this money goes and how long it lasts. And as you said, this could be a couple of years. This could even be decades if we truly see that change in tenor. But is that what you think is happening here? Is that a true shift away from growth? What the U.S. was focused on, what gave the U.S. markets all their greater valuations, now to other sectors that quite frankly have lagged for decades?
I think certainly there's no evidence I see that this administration is going to, turn around on a dime and say, oh, the market's doing this, so forget everything we just said on the campaign trail, what we've done since we took office, the kinds of people we've put into office to support the administration and so on. So, I don't know about decades, but I do know that, we just had this election and we're going to be in Trump 2.0 for the next 3.5 years, give or take, or, a little more than that. So what would really change that big picture trend for at least the next few years? I don't really see a lot. I mean, so the short answer is, for at least the reasonable investment horizon, the next couple of years, yeah, you're going to want to be more, still in precious metals. You're going to want to be more in international stocks. You're going to want to be more in things that are undervalued and have not moved the way the big dominant tech Mag 7 type names moved. So yeah, I don't, I think when you see big adjustments like this, that you always get very large, very sharp short-term moves, and then you usually correct some of that, and everybody kind of catches their breath and says, okay, the exciting part's over. But what happens with the unexciting part? What happens with the slow money, the institutional money, the people who have longer-term investment horizons? And I do think that the logical answer is, hey, they may do short-term things to pause some of the stuff going on, but do you think that has Trump or his team given any signal that, like, they're looking at the market and panicking and saying, you know what, I'm going to throw out years and years and years of my thinking that the U.S. has been taken advantage of, and I want to fix that? And I don't think there's any evidence that's the case, and I don't think it's going to change. So yeah, you got it. Yeah, as an investor, you want to look at things that are undervalued. You want to look at things that give you more of a margin of safety. You want to look at things that hadn't moved, that relative to some of the things that were wildly overowned. And obviously that's something like gold. It's funny, actually, I did an interview with Tom Bruni over at StockTwits for this week's podcast. and not to give anything away, this will actually publish after that does. But he pointed out, they did a sentiment study, and they obviously have younger, more active traders and so on. That's kind of who they serve. And they do a lot of social sentiment data that's not just, qualitative, but quantitative. What people are talking about, they crunch a bunch of data on what people are talking about on their platforms and how they're talking about it and so on. And one thing they did was they ran a poll asking, whatever, a couple thousand of their members, what you're seeing gold at all-time highs, how exposed are you to that relative to crypto and some other stuff? And that sort of mainstream, retail investor money, he said he was even surprised that they were not overexposed. It wasn't like people were trading, tips like, I want to ride the next $40 in gold. It's going to go up $500, blah, 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 any of that kind of like hyperactive stuff that people would do about meme stocks and things like that at the peak for those bubbles or booms. You're not seeing that. Anything, I would argue that maybe kind of your mainstream money is seeing it, it's reacting, but it certainly doesn't seem to be like in the blow off top phase to me.
No, Mike, I mean, as a platform that swims in the commodities and we have a lot of gold focused people, I can tell you that we're not seeing like a huge influx of rocket ship emojis and to the moon calls. And we're not seeing that kind of excitement that you'd see in the crypto space or in the meme stock space or even in AI and the tech stock. So there's still a long way to go. I got a question for you, though. When we were talking to you years ago, your mantra was to be boring. And because it was the defensive time, and this was after the 2021 spike going into 2022, you were saying, be boring, get into the value sectors because it's going to be a rough slog. Then you shifted it to be bold, and you were right on because that was the time where the markets were picking back up in 2023 and 2024. Are we back to being boring, or are we just being bewildered? How are you playing like the value versus growth side of things?
Yeah, that's interesting because I'll be sort of putting pen to paper, or at least fingers to the keyboard for a PowerPoint for our Miami event next month. And I've been thinking about that a lot. I think it's kind of a different environment than a pure just buy consumer staples, buy utilities, which was sort of the prescription back pre-2022 that worked well. This is kind of a different type. You want to be less bold. You want to be. I'm trying to think of how I'm going to characterize this. I guess I can't reveal any great thoughts here just yet because it's been swimming around in my head for a while. I think you want to be adaptive. I guess you want to be flexible. It's not like a full. I think this market's going to crash. You got to hide under a rock or so on. But I think it's going to be rotational to more global. It's going to be rotational to more sort of re-industrial defense and defensive to some degree. It's going to be things like metals that I think still work. There's going to be, industrials and some machinery type names that play off of that. So again, it's a whole different type of quasi-defensive approach, which is, again, hopefully this isn't too much of a word salad, but I think that, it's an environment where, unlike before where it was defensiveness was being by traditional sort of financial market developments, exuberance popping in the SPAC and money, money losing tech company space, some of that type of stuff. This is more politically and policy driven. This is more, reordering of kind of world trade and so on, which is a whole different ball game than we've seen in years and years, maybe decades. So not sort of your pure, more financial economic cycle driven defensiveness, which is where I was at a few years ago, but a different animal. And I think that's going to require kind of some different prescriptions.
So because it is a different animal, and as you said, we have a little bit more than 3.5 years max of this Trump presidency. But again, so much is being done outside of, let's say, normal business cycle or normal market type of moves. Could this all reverse on a dime? Could this just be a great buying opportunity for U.S. markets whenever this bottoms, even if it is in, let's say, 3.5 years?
Yeah, absolutely. And I mean, I think that there's going to be U.S. stocks in some sectors that I think that are going to do okay. But, I don't think it's going to go back to sort of the all U.S. all the time and within U.S. all tech all the time. That was kind of in hindsight, that might be seen as sort of the peak U.S. exceptionalism, at least from a financial standpoint, for years, and I think that's an important dynamic. So doesn't mean there aren't going to be multi-week and even multi-month trades. Doesn't mean there's not going to be some, U.S.-based companies, U.S. equities. They don't think, you just take all your money and shove it into foreign stocks versus U.S. But I do think in terms of the weighting, especially because you go back and just the amount by which value was underperforming growth, US was outperforming global, metals were underperforming equities, and so on. I mean, things were so wildly stretched. When we got kind of the peak of Mag 7 euphoria a year and a half ago, that I don't think that's something that changes in, again, 6 months or 12 months. I think it's something that's going to be almost it's going to be part of a multi-year rotational process. So yeah, I mean, I don't hate on some of those companies. I'm of course going to own some of them either directly or indirectly. But do I think it's a market where it's just, tech is the thing and you can pretty much ignore everything else? No, and I don't think that that's going to be the case probably for a long time.
Yeah, such a great point, Mike. I don't think it's going to go back to the way that it was. And we were pointed out over and over again on our show at the time that the valuations were at nosebleed levels, that everything was focused into a very narrow breadth, and that people were tunnel vision and ignoring almost all of the other markets in the world and even in the U.S. exclusively. But just because we have so many people that follow the commodity space, I'd love to get your thoughts on how you think commodities like oil and copper and base metals are going to fare if we go into a recession. First of all, are we going to have a recession? Do you think that that will hurt the commodity cycle, or could we have what some people are calling a similar analog to the late 70s, where the commodities still rip even in a stagflationary environment? How are you looking at the macro in relation to commodities?
Well, I think, something like oil, I don't think we're going to get anything like the real major collapse we saw, obviously, in things like COVID, negative oil prices and stuff like that. But, and frankly, the drill baby drill prescription is sort of a self-immolating, a self-sacrificing type strategy because it's helping the expectation of it's helping drive prices lower. And I think the oil industry in the US is now like, well, we may have a policy friend in Washington or an administration that's supposed to be energy friendly, but if oil here at what, $62 give or take as we're talking, we get below 60, get closer to 50, you're going to see a lot of capacity shut in because these guys can't make money. So I don't anticipate any like major collapse in oil. I don't think it's probably one of your best places. It's going to be more stable to flat to down a little bit. In the metals sector, obviously, I've favored precious over base for a long time. I do think you're going to see some scrambling in readjustment in the metal space, some of these niche metals, rare earths, and things like that. Obviously, the U.S. and China are doing, and as that policy unfolds, kind of the geographic winners and the potential for big moves in smaller parts, niche markets within commodities and metals. You're going to see a lot of that just because it's being reordered. I mean, if China is shutting down exports of these rare earths and to try and fight back at the U.S., who knows how that's going to impact some of these smaller parts of the market. And there's going to be opportunities for people who are nimble. But I mean, if you want to keep it simple for the sort of the big picture investors, gold and silver, like both a lot. Copper, I'm okay with, and when it comes to the equities, I think there's probably still a lot of catch up to be done. I mean, you're seeing these equities start to rock, but when you consider how much for how long and how much the underlying metals markets moved, and yet these equities were ignored for so long, there may be more catch up potential there.
There a subsector of these equities that you find are the best opportunities right now? Would you go down into the riskier juniors, or do you think that it's still a game of maybe the more advanced, the slightly larger, even though they're tiny in the whole scheme of things in the financial world, some of the bigger miners or development plays?
Again, I mean, I'm not the special. You guys have a lot of specialists and experts who really can get down to the nitty gritty on some of these sub $5, even sub $1 type companies. So I'll leave it to those types of experts. But I don't think there's any problem with allocating more money to speculative type names because some of the people that I've had on the podcast or the stuff that I follow their written work, they point out, look, as you get into sort of the last couple of innings of a bull market in precious metals, you tend to see silver outperforming, you tend to see juniors and so on outperform the majors. So if this is truly going to be one of those phases, and it kind of looks like that to me and a lot of other people I talk to, then yeah, you got to be, if you got to be speculating, or if you want to make big gains, that's where they're going to come from.
Yeah, so true. It's that balancing act where the big guys move first and the money filters down, and when the little guys move, boy oh boy, they can really move. But at the same time, that can also be end of cycle, end of bull market type of action too. So I think having that balanced approach does make the most sense right now. And quite frankly, there's a lot of these precious metal stocks that are doing very well. Yeah. Mike, it's great having you on the show. Thanks for sharing some of your insights of how you're seeing these markets and what potentially, again, this is just potentially, could be a generational shift in markets and money flows that we are just starting to see. Again, Mike Larson is the editor-in-chief at MoneyShow. You can click the link in the show notes to find out about the upcoming Money Show in Miami in about a month's time, May 15th to 17th. Mike, thank you very much for your time, and everyone stick around. We're going to be right back with even more of a focus on the metals equities.
Thanks, guys. Looking forward to it.
Al Corlin's firm, A.B. Corlin and Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout.
All right, welcome back. Continuing to listen to the weekend edition of the KE Report. Now we are shifting our focus pretty much exclusively over to the metals sector, resources, commodities, as we are chatting with Matt Geiger. Matt is the managing partner at MJG Capital, runs a fund that is focused on investing in, let's say, junior to mid-tier companies in the resource space. We always get Matt's insights on what he's doing within the fund's portfolio and his thought on these broad markets. So, Matt, it's been a little while since we last chatted. It was the end of February. That was our last conversation. And boy, oh boy, a lot has happened in the world, in these markets, and out of the U.S. over that time. A lot dealing with tariffs, geopolitical issues that has caused a lot of volatility in the markets, but it really has benefited the precious metals, especially gold and the gold stocks. Gold stocks are doing very well right now. Let's just start off with a bit of a recap. Your takeaway from Liberation Day, the new tariff regime, how this is all filtering into all of us investors that are invested in the metal space.
Well, the world has certainly changed since we last chatted, Corey, so good to be with you. And I mean, I am pleased to say that the MJG portfolio is up sharply on the month, but boy, has it been a stressful couple of weeks. I feel like I've aged a couple years since Liberation Day alone. And really those 4 or 5 trading days immediately after Liberation Day were a real gut check for anybody participating in the mining space, let alone the junior space. But obviously things have improved quite markedly. Even if you just look over the past 5 or 6 trading days, it's been day after day of substantial gains within the portfolio. I will say from a very high level, tariffs are a mixed bag for those of us with mining exposure. So let's just put gold to the side for the time being. But for the rest of the metals complex, tariffs are going to reduce global GDP and hence global demand for metals, plain and simple. The U.S. effective tariff rate on imports was roughly 2.5% last year. We'll say 3% in the previous regime. This, of course, jumped to 27% in terms of the tariffs that Trump announced on Liberation Day. But even with his subsequent decision to reduce reciprocal tariffs across the board ex-China, we're still at 22.5%, 23% effective tariff rate when reflecting the subsequent increases to the China-specific rate. So we haven't seen a jump of this overall magnitude in terms of tariff in the United States, going all the way back to literally the 1860s. And I would argue with the U.S. in the very center of the global economy. Anybody that doesn't believe this is going to have a significant effect on global economic growth and hence metal demand is deluding themselves. So that is one side of the coin. The other more positive side of the coin is that I'm increasingly convinced that Trump has single-handedly ended the nearly 17-year run of U.S. equities, basically trouncing any other asset class globally. So I would argue the era of U.S. stocks outperforming emerging and international equities, new economy stocks outperforming the old economy, growth outperforming value, I would argue this is over. And as a result, there will be literally trillions of dollars of capital that has been served very well in recent years, just resting in the S&P 500, looking for a new home over the coming months and years. And at least based on the price action we've seen so far, this new home is unlikely to be in US dollars or US treasuries. So this will be to the benefit of the very asset classes that have been trounced by US equities really since the great financial crisis. So I do see this as exceedingly bullish for commodities, emerging market equities as well. I would say international equities more broadly in the years ahead. So again, it is a mixed bag, but I think at least over the medium term, this will prove to be a net positive for those of us with natural resource exposure. But of course, buckle up because there's going to be significant volatility in the weeks and months ahead.
Well, Matt, you said it, man. I mean, it's definitely changing the script of U.S. equities dominance and the place of commodities. There's even been a lot of executive orders dealing specifically with critical minerals, with copper, even a second critical minerals one that just dropped in the last week. And we can't ignore the one commodity, or I guess monetary assets that you put to the side, which is gold. I'd love you to get you just to weigh in on the move in gold. It seems like as the sole safe haven, people used to turn to bonds. They would turn to the U.S. dollar. There seems to be a real shunning of U.S. assets in favor of piling into gold as the safe haven globally in almost every currency on the planet. What's your take on the breakaway train that is gold?
Well, you put it well there, Shad. I mean, it really is the only game in town for investors that are looking for a safe haven. At least since Liberation Day, and things may well change, but the U.S. financial markets are behaving more like an emerging economy would, where we're not seeing that traditional flight to safety to the US dollar or to US treasuries that we've seen going back many decades in similar circumstances of uncertainty. And gold has reaped the benefits of that. I mean, heck, the gold price is up 27% year to date as we speak. That equals the performance of 2024, which was a phenomenal year for the gold price, also 27%, the greatest annual gain in that asset going back to 2010. So we've already replicated the 2024 results in just over a quarter. And, I've said this on this program before, I'll say it again here, we've come a long way very fast. So again, of course, the market does not heed to my wishes or desires, but I would not mind at all for the gold price to hang out and even, pull back to 3,000 and just consolidate there for 6, 9, 12 months and give us a breather. Because if I could have my way, we don't have a blow off top here, 6 or 9 months down the line. And this, move in gold can be longer lasting into the later stages of this decade. So we will see how that plays out.
Matt, with all these tariffs, then tying that back into maybe investing themes in individual companies, how important is where projects are located right now, taking into account that geopolitical risk?
Yeah, I mean, I would say at least from the MJG portfolio perspective, I'm more tolerant of geopolitical risk than most investors that are out there. It's the right team. It's an exceptional project. You're paying a fair or discounted price. I think as long as you don't put too many of your eggs in any given basket, over time, that's the right way to approach things. So certainly one has to reassess in light of the decision making that's coming out of Washington. But as it stands, I haven't made any major decisions in terms of portfolio allocation. And so we're sticking with the jurisdictions that we have exposure to and not making any knee-jerk reactions, that's for sure.
Well, Matt, just one more factor to bring into this is, in addition to different countries, specifically China and the U.S. having the trade tariffs, trade wars going back and forth, the other comment we've heard is that maybe China is liquidating their treasuries and that's how they're going to get back. But that doesn't make sense mathematically because they wouldn't be able to roll that money into anything else paying as high of a yield. It seems like China's approach has been to use export bans on a lot of other minerals, things like tungsten and antimony, rare earths, germanium. So there's a lot of those critical minerals that they're putting export bans on. And that's caused a lot of companies in the resource sector to focus on finding more of those or highlighting those in their portfolio. Have you seen any trends in the market or in your own portfolio as it relates to critical minerals as a result of these Chinese export bans?
Yeah, well, that has been a big story, really going back to the later stages of the Biden administration. I would say, especially at PDAC, antimony and tungsten were particularly topical. And then, of course, with China's move just on Sunday afternoon, at least Pacific time, further ratcheting up their rare earth export bans to also include magnets that contain rare earths. That's become very topical, and we're going to see articles flowing out about that particular decision for the next couple weeks. So certainly on the top of investors' minds. Perpetua Resources is an interesting company. I would argue that they're through and through a gold play. If you look at the percentage of revenue that is expected to come from their antimony byproduct, it's close to probably 6 or 7% at current prices. So it's a gold play through and through, but they've been able to effectively use their antimony byproduct as a way to accelerate permitting and also receive significant quantities of financial support, both from the U.S. military and then more recently from the Export-Import Bank. So I think companies can wisely, if they have byproduct exposure to some of these critical minerals, even if it doesn't have a huge impact on their overall project economics, they should follow the Perpetua model and see if it can help streamline their permitting process and get some urgency around getting that project fully permitted and across the finish line. We're also, of course, seeing a few companies do spin-outs of projects that are being branded as more antimony focused. Liberty Gold is one example of that. We also have a holding within the MJG portfolio. I shouldn't say yet, but I think they're probably working on doing a tungsten focused spin-out themselves. So lots going on that front, and we can also touch on rare earths a little bit as well.
Well, let's go to rare earths then, or really anything else in terms of these executive orders, in terms of the U.S. seemingly to be more interested in developing some domestic supply. However, again, I think the market still does wait to see some deals getting signed, some funding coming in. So any other, different metals that do have your attention in terms of an investment angle?
Yeah, I think it'll be interesting to your audience, and this will be a KE report exclusive because this is not a name that I've discussed publicly. It's one that's been in the portfolio for maybe 18 to 24 months at this point. But on Monday, we added pretty significantly to our Neo Performance Materials position, which is our only rare earth focused investment within the MJG portfolio. Neo is the only Western company globally with the capacity to do all of the following: separate rare earth concentrates into rare earth oxides, take those rare earth oxides and reduce them further into rare earth metals, turn those rare earth metals into rare earth alloys, and then take those rare earth alloys and manufacture them into powder and now sintered magnets. So it's basically a one-stop shop for the entire rare earth value chain, absent the first step, which is, of course, mining. And as some of your listeners probably know, at this point, 40% of global rare earth mining is now conducted by non-Chinese parties outside of China. So that's a very significant change from where we were during the last rare earth mania, in the 2009 to 2011 time period. So the world as a whole has actually reduced its dependence on China quite significantly as it pertains to that very first step, which is mining. The problem, of course, is that 90% of the necessary following steps, the separation, the reduction into metals, the alloyization, is occurring within China, and then China is also producing 90% plus of global permanent magnet supply that contain rare earths. So they do still have a stranglehold on the supply chain as a whole, just less so on the mining front. And so on Monday, when I woke up and saw companies like MP Materials and then earlier stage companies with US-based assets, trading up 20 to 45% in one case on the news that came out of China on Sunday, and I saw Neo had only moved by 5%, it really did seem like a fat pitch to increase our position sizing. As I do think the market is fundamentally misunderstanding how the rare earth supply chain actually functions and our continued reliance on China, not on the mining front, but in all the necessary following steps needed to make a magnet. And as mentioned, Neo is the only group in the Western world that can do all of those steps. And I think they're an extremely strategically significant company that is simply not getting its due amongst the broader investment community.
Well, Matt, I really appreciate you making that a KER exclusive here today. And yeah, that's a company that's been around for a while. In fact, at one point they were folded into Molycorp in the prior cycle, and then both spun out separately again to form MP Materials and Performance in this cycle. So they have all that downstream. And I think you're right. A lot of investors in our space focus only on the mining stocks, but they're not looking downstream at all the processing and separation you need with rare earths. There are a few other companies working on those, but it doesn't get as much airtime. So I really appreciate you putting a highlight on the rare earth sector. Let's widen the scope, though, for you, Matt, in the MJG Capital portfolio. In light of all of these moves and all of the commodities, are there any other changes you're making inside of the portfolio?
Sure. Well, I've mentioned NEO, of course. I would say we've been quite active, actually, since we last spoke, maybe 5 or 6 weeks ago. Probably the most noteworthy piece of news is that we've actually initiated our first new position. This was last month, going all the way back to June of last year when we participated in the Corex copper financing. So until this most recent investment, it had been a good 7 or 8 months since we'd added a new name to the MJG portfolio. So that's exciting. I am not willing to share the name of this new investment as it's still under accumulation as it pertains to the fund. But from a high level, it's a sub $20 million junior that holds an equity portfolio that essentially covers the company's entire market cap. And then with that, you get multiple gold assets for free, owned 100% by the company, but there's one in particular that's particularly interesting. So we did initiate this position when it was trading at a discount to the value of the equity portfolio. So it had a negative enterprise value at that time. It subsequently had a pretty nice rally in the week since. So it does have a positive enterprise value of, $1.5 million or $2 million at the moment. But for all intents and purposes, you get the company's 100% owned gold assets for free. So that's the newest, broad strokes, that's the newest name that we've added to the portfolio. Otherwise, we've trimmed a couple positions, by 10, 20% each. Nothing serious, just to free up some cash. And we've also started the process of liquidating an underperformer at a loss, unfortunately. I guess some spring cleaning, so to speak. But I imagine it will take a number of months for us to complete that process realistically, because the name is very illiquid.
Matt, broadly, are you just seeing a lot of opportunities out there with stocks, a lot of these stocks moving higher? I know people are still somewhat disappointed at some of the action, especially in the juniors, but I'm seeing a lot of stocks leveraging the gold price move and breaking to either 52-week highs, some even to all-time highs. Do you see just a wealth of opportunities out there, or is it still very a selective game for you?
Well, it's always a selective game, but opportunities certainly abound. I will say, though, we're sitting pretty tight with our current portfolio. I mean, maybe we'd add another name by the end of Q2, but I would put the odds of that at less than 50-50. And I'm comfortable with the 18 positions that we hold within the portfolio as it stands. Two of those are private, so 16 of those are publicly traded. So largely sitting tight. And if I see companies rally closer to or well above what I view fair or expected value, I'll take profits, if not sell entirely. And if I see stories, NEO being one example, that I don't think are getting their due relative to the rest of the portfolio, I'll take action accordingly. But as it stands, I mean, we're pretty much fully deployed. We have a low single-digit cash position as it stands. So not a huge amount of capacity to go out there and, add another 2 or 3 names, at least in the near term here.
Well, Matt, another point we should highlight is that in addition to more funds finally getting some inflows, in addition to retail investors finally getting into some of these stocks, even generalists possibly getting into some of the gold stocks for the first time in a long time, we also see insiders getting into their own stocks. So maybe break down some of the data you had to share with us today about insider buying.
We do. I think this is a really interesting phenomenon that I haven't seen too many people speaking about as of yet. So high level, I mean, the TSX Venture is up 7% year to date as we speak. And this on its own is somewhat remarkable. I mean, I think most would argue that we're in what can fairly be described as a risk-off environment. And yet the venture is outperforming the Toronto main board, the TSX, by 9% year to date, and it's outperforming the S&P by 16 or 17% year to date. So the outperformance of the TSXV as more of a speculative index is remarkable in its own right. But coming back to the insider buying, typically in a period of strong share price action, like we've seen in the TSX Venture, you'll see roughly a 1-to-1 ratio, if not a negative ratio, in terms of companies with net insider buying relative to net insider selling. So again, typically in periods where the TSXV is rallying, you'll see at best a 1-to-1 ratio between net insider buying and net insider selling. But as it stands, this is not what we're seeing today. The latest figures that I've come across, and this is from Inc. Research, is that, and this is looking at their insider sentiment indicator, is that it's currently above 400%. So in other words, 4 companies on the TSX Venture are experiencing net insider buying for every one that's experiencing net insider selling. Again, highly anomalous in a period where the TSXV's price action has been very strong. And it's a similar story for the miners as well. If you look at the miners listed on the TSX main board, the sentiment indicator is at roughly 190% for gold miners, specifically on the TSX. So that's 1.9 companies experiencing insider buying for every one that's experienced selling. And if you look at the diversified miners, that indicator's closer to 350%. So I would argue this is an acutely positive sign for the whole space, really from the seniors down to the smallest of the juniors. And I will say we're also seeing the same phenomenon playing out within the MJG portfolio. I'd say the 2 shining examples would be Lara Exploration and the aforementioned Corex Copper. Regarding Lara, and I noted this on social media earlier this week, we've seen literally 31 different insider transactions over the past 60 days between 4 different insiders, including the chairman, Miles Thompson, and the CEO, Simon Ingram. And I mean, we've held Lara shares for over 5 years at this point, and I've never seen anything like it in terms of insider activity from the key players, which already own close to 20% of the company. So skin in the game was never an issue there, and now it's even less of an issue. And for Corex, which was featured as the featured investment in the most recent MJG partnership letter, we're seeing similar activity, maybe not quite to the same degree. We've seen 9 different open market purchases since the beginning of the year between 3 key insiders, including the CEO, Hayadon, and the new exec chairman, Alan Friedman. So it's really hard not to have your spirits buoyed, as a shareholder when you see management really putting their money where their mouth is to this degree.
Matt, do you think this lowers the risk profile of some of these juniors then? Because it is still the sector, or the part of this sector, that some investors are waiting for. Even though these juniors sometimes don't even have assets, a lot of money does focus on these juniors, saying, when are they going to start to move now that we're seeing more insider buying? Is that, obviously it's positive, but sometimes we see insider buying that simply just supports a share price. Now could it further drive the share price higher?
Yeah, perhaps. Again, that's a very extreme skew at over 4-to-1. So I would argue it's a positive for the junior space as a whole, undoubtedly. I don't know if I would describe it as, lowering the risk profile, because again, all investors should go into this with the assumption that 80% of the juniors out there are gonna lose money over time, if not go to zero. So you still got to be as selective as ever. But if one is, looking at initiating a company or a position on the open market, look at the recent insider activity. In some of the cases, these companies may need to raise in the relatively near future. So that's another thing to look at, of course, insider participation in upcoming financings. So some groups where we maybe haven't seen insider buying to date, we may see a financing in the next month or 2. And then the thing to look at there would be how much of the financing, if any, is being taken down by the insiders. So this is in its own right is not a reason whatsoever to buy a given company's share. But for me, people are at the very top of the list in terms of the variables that one should look at when considering an investment. And you want to see skin in the game. And if you see buying, I mean, as the saying goes, there's really only one reason for these insiders to buy. So that really firmly checks the people box in certain circumstances, and then one can get on to the other variables as you consider whether to invest or not.
Yeah, Matt, such a great point. There's lots of reasons to sell, but only one reason to buy. So nice to see that insider buying. Let's talk about the other side of this equation, though, which we haven't really had to cover in years, and that is, when do you sell? And the question I want to ask you is, as a fund manager, you already alluded to trimming a little bit back on a couple of positions that have been running, but we're going to get to the point where some of these stocks have gone up multiple fold, and people have to make a decision on whether they want to horse trade one company for another if they see other interesting opportunities. As a fund manager, how do you decide when to sell out of a position? Do you do it in tranches? Are there ever times where you just liquidate the position and ring the register? How do you deal with selling the winners?
Yeah, it's a good question, and I think it's very nuanced. I think one important differentiation to make right off the bat is whether you're valuing your holdings. And I think all investors should have a number in mind for each and every one of their holdings for what they think fair or expected value is. So for producers, royalty companies, maybe later stage developers, you can have a little better sense of what fair value is. Basically what the company is worth, all else equal, and if you see a significant delta between the current price and what you deem to be fair value, most often using discounted cash flow analysis. One could, in some circumstances, maybe amongst the royalty names, use an approximation of relative value to determine this figure. But what is the delta between price and value? And ultimately, as the price goes up, unless there's been a step change development at the company that's changed that figure, every cent that goes up, the company is that much less attractive. But for those types of fair value stories, I'm a little more comfortable. And NEO is an example of a company where I think you can reasonably come to a fair value. I'm a little more comfortable holding that position up until it reaches fair value. And at that point, I will certainly start taking profits. I won't necessarily sell instinctively immediately. Oftentimes, you'll see companies overshoot fair value, but certainly start aggressively selling. And then in the case of an overshoot, you can perhaps exit at an average cost that is above what you deem fair value. But I think if you look at the earlier stage companies, the explorers, it's very difficult. You can't estimate a fair value. You have to look at expected value, which is certainly more of an art than a science. And I think if you have a drill play and you have a certain expected value in mind, even if the company's trading at a significant discount, maybe you have, hypothetically a fair value of $1 per share in mind, the company, or expected value, of $1 per share in mind, and the company's trading at 30 cents. Sure, the company would have to roughly triple from current levels to reach what your expected value is. But because of the inherent uncertainty of an expected value calculation, particularly for early stage explorers, I am much more willing to take profits when the company's share price moves, particularly if that move is not driven by a fundamental catalyst. So maybe this hypothetical company at 30 cents comes out with a great drill result and it moves up to 60 cents. That would be a reason to stand pat. But if you see that same company move up to 50 or 60 cents purely on the anticipation of an upcoming drill program, or purely on a change in sentiment in the broader market, even though in my mind at 50 or 60 cents, it's still trading at a significant value to what I've determined expected value to be, I am much more willing to take capital off the table. And I think in many of these situations, when the company's moving not on a fundamental development, but rather on excitement about upcoming programs or upcoming news flow, that's a good opportunity to de-risk. And, in a best case scenario, take your entire cost basis off the table. So at that point, you're playing with the house's money. So yeah, from a high level, I think as you think through this for the individual positions in your portfolio, I think it can be helpful to differentiate which of the companies, again, generally later stage, do you actually have a firm fair value in mind, and which of them do you have a rougher approximation of expected value, and then act accordingly.
Fair enough. That also ties in with some of the smaller companies, right, that do need that news. And you also need to factor in dilution too. So sometimes look at the share price, but also factor in what the market cap is and what it'll take to get there. But hey, right now, Matt, there's a lot of stocks that are performing very well in especially the precious metals sector. So hopefully our listeners are enjoying that wave of winners. They're taking part in it. And yeah, trim, take some gains, but also this is a time to be invested in this sector as these share prices move up and as money filters a bit more even down the food chain. All right, again, Matt Geiger, managing partner at MJG Capital. Always fascinating to hear what you are doing within the portfolio, Matt. Thank you very much for your time. And everybody, thanks for tuning in to this weekend show. As always, go back to our website, podcast, YouTube channel, and our new Substack page to check out all our daily editorials and company updates from throughout the week, and keep in touch with Shad and I through email. Everyone, thanks for tuning in. I hope you all have a great rest of your weekend.
The Corlin Economics Report is produced for A.B. Corlin and Associates. Opinions expressed on this program are intended solely for the entertainment of our listeners, do not constitute investment advice, and are not necessarily those of this network, radio station, or our sponsors. Find out more about this program and today's guests by visiting www.kereport.com. For Al Corlin, this is Colleen Robbins. Join us again next week for the Corlin Economics Report.